What's going on today, YouTube? Hope you guys all had a great weekend, and today is Monday. The market is closed because it is President's Day. So today, I'm going to go over security analysis for the beginner. I'm going to kind of go through the SEC filings and show you around where to start looking, how to familiarize yourself with those SEC filings, because I know they can be intimidating. Anyways, if you're new to my channel, I make daily videos helping you guys in the stock market with investing, and I cover long-term, short-term, technical analysis, stuff like that. So if you're interested, check out my other videos, subscribe to my channel, leave a like below, comment, let me know what you guys want a video on or what can help you, and share it to someone else if they could use it. So let's get into this. We're going to go down here. This is just sec.gov. Go to Ford. I've talked about Ford in other videos, so I figured it'd be good to actually dig through their SEC. And today, we're just going to go in the 10K annual reports that just got filed February 8th. So go into Documents, 10K, and we'll go to Complete 10K. Okay, so here's the form. Today, I'm going to cover 7 things you need to judge a company on when you're looking for security analysis. Number 1 is going to be adequate size. This is just the size of the company and how many sales they're doing annually. So, we're going to break it down. We're going to go to wholesales first. Wholesales. Now, you can read this, but I want to make this a little quick. Wholesales is basically when a company sells items in bulk. And make sure when you're looking at these graphs, bars, charts, whatever, you check up here and figure out that these numbers, so this number is in thousands of units. So add 1,000 to this value if you want the whole number. They just make it like this to make your calculations easier. But make sure you know what units you're in. So, wholesales, if you read down here, it's what they sell in bulk, basically. So this is what's going to dealerships, in a way. If you want to see what they're selling to customers, you go to retail sales. This is actually what's bought from a dealership, basically, when it's actually getting to a consumer. So when an actual consumer buys it, someone that's going to use it every day, it goes under retail sales. So for adequate size, a good number to look at is that the company is doing no less than $100 million in annual sales per year if you're thinking about investing in them and you want to make sure you're going into a secure investment. This is just showing, it says retail sales in millions of units. Total company, 6.5. So they're selling 6.5 million units 2015, 6.7 in 2016, 6.6 in 2017. Now, if you're thinking right now, okay, that 6.6 is nowhere close to 100 million. Remember that this 6.6 million is units. They sold 6.6 million units. So the easiest way, you could look at their cheapest vehicle they sell, see how much it costs, and then multiply 6.6 by that dollar amount, so you get the worst case scenario. If you want to get just an average, take the lowest cost vehicle and their highest cost vehicle, or take every vehicle that they sell, add them all up, divide them by the number of vehicles they sell, and then you can get the average price on the vehicle if you want to do it that way. It's up to you. None of this is a complete science. It's more like an art when you're going through SEC filings and figuring out if a company's valuable or not. Number 2, they must have strong financials. Financials is just talking about assets and liabilities. So we want to look for assets, go down, search, find assets, and total assets. Balance sheet data at year end. Okay, so there's your total assets for the year. For a strong financial, you want to make sure your assets double your liabilities and the long-term debt does not exceed the net assets. Now, debt can be a little tricky to find at times. There's a lot of footnotes in these SEC filings if they are, quote, like sketchy companies, but if you're looking at larger companies, they're most likely not sketchy trying to hide stuff from you, but just be aware there are companies that do. And I don't know, it'll probably never change, but it's just how it is. And believe me, they can get in trouble for trying to cover up something in their SEC filings. That's just not clear to their public viewers. But total assets, you can look in here, and then you can search liabilities. And here you go, liabilities, total liabilities. And you can also look through and figure out what are they adding up to make these liabilities, and then look at your total number. Don't always just go, okay, there's total liabilities, there's the number, boom, done. Make sure you know what you're looking at, what they're putting in there. Third, make sure the company has continued dividends over the past 20 years. So right here, in this chart right here, if you're looking for dividends, this just shows stock price per share, high, low of the quarter. I'm sure you guys know by now, stock fluctuates all the time. So first quarter, second quarter, third quarter, fourth quarter. And it breaks it down, what dividends they paid, what their stock price was, so forth. Just be aware, I'm going to make a video on this tomorrow, but just because a company does or does not pay dividends does not mean it is a good or bad company. Number 4 is no earnings deficit in the past 10 years. On this 10K, you can see they're only reporting from 2013 to 2017. So you go back and you can go back in time and look at the other annual reports. Pull up one from 2013 to 2014, and it should show the previous 5 years from that date. So you could pull up one from 2018 and pull up one from 2013, and you should have 10 years. Big drops or big rises could be bad in earnings per share. Just be cautious, and if you do see one, try to do some research. Be like, okay, in 2000, it didn't happen here, but okay, 2014, this company had a huge drop in their earnings. Dig up, there's always new, everything's on the internet nowadays. Easier today than it ever was to find past history on companies, what happened, what they did. So figure out if it was a big scandal, something good, something bad, and figure out why that price drop or rate rise was so drastic. Number 5 is going to be 10-year growth is at least 1/3 in per share earnings. This can be a little tricky to get, but it's going to take some time. But you want to go year by year. Figure out what their earnings were, and then you're going to start, say it's 2000, you can get up to the 2017 report, because 2018 is still ongoing, so that's not going to be out yet. So go back to 2007, and then you're going to go from 2007 to 2008. See what their earnings difference was. Take 2008's earnings, subtract 2007's earnings, and divide it by 2007's earnings. That'll give you a percentage. That'll give you your percentage in earnings growth. Now, you're going to have to do this every year, the whole way up to 2017. And then once you have all those values added together from each year, every year's earnings growth, divide that number by 10, and it'll give you your average annual earnings growth over the 10-year period. Yes, it's going to take some time, but if you truly want to value a stock and see how they're going, you need to look at this stuff. And if you look at it this way, it's a lot better to take some time now to figure out if you're going into a good investment or not, rather than waiting in the future when all your money's gone. Your hard-earned money that you put into this company is gone because you didn't take, maybe a couple hours to do your due diligence to go through these reports. To me, it's worth it, but everyone's different, so figure out what works for you, easiest way you can value these companies, easiest way you can make a good investment. So if you don't want to do this, then you're probably more of a index fund that replicates the stock market type of guy. And that's fine. There's nothing wrong with that. Just know who you are, know what you want to do, know your possible outcomes of what you do. Number 6, you're going to make sure the price of the stock is no more than 1.5 times its net asset value. This is just a way of saying if the price of the stock is overpriced or underpriced. See what their values are, see what the current stock price is, and this is always going to change. You have to know the current stock price. But that's easy to look up. You can look it up online, you can look it up on TD Ameritrade, whatever you want. And number 7, the last one in security analysis. You want to make sure the price is no more than 15 times the average earnings of the past 3 years. So when this all comes down to it, this is pretty much saying the PE ratio is not greater than 15. I want to warn you right now, the PE ratio that you see on websites and everything is calculated, and it's usually trying to represent the future. When Wall Street gets this number, it's not the actual PE ratio, it's calculated in because they want to make sure they're valuing the stock for the future, not just for the current state. A lot of these bigger companies out there, their PE ratio is at least 20 to 25 times earnings. So it is pretty hard to find companies for less than this nowadays. These PE ratios can be way out of proportion because it's what's expected from the company in the future. And remember, no one can tell the future. No one knows what's going to happen. No one knows what's going to happen to the company. If lawsuits can happen, anything can happen. They can go bankrupt. Who knows? So this is a way for Wall Street to scare people away from investing in these companies. And you need to calculate this yourself. I said you can't just go off these numbers they have online. Figure out their price of the stock and divide it by earnings per share. And that gives you a simple PE ratio. Do this for consecutive. Don't just look at what it is right now. Look at it what it was in the past, what it has gone through every year until the year you're looking at now. I'd say even 10 years. Figure out if it's staying consistent, if it's dropping, if it's rising. So that's all for this video. I just want to try to get you guys into these SEC filings to figure out where stuff is. And honestly, think about this. It's a lot easier than it was years ago. Now we can just use that nice little Control F button and dig through these quick. In the past, you need to send in for these SEC filings, get them mailed to you, and you would have to read page by page to find what you wanted. So it's a lot nicer nowadays. They're all online, and you can find stuff a lot quicker than you used to be able to. If you've never read through one before, though, I recommend you do, just to see what they can throw in. It is hard to read. You need to take your time because the people that write these, they're good writers, and they use there's keywords out there that they can use to try to hide stuff from you if they are trying to cover something up. And legally, they can do this because they're stating it in there what's going right or wrong for the company. So they're giving you the information, but it's almost like a very tedious to find this one word that could persuade that whole sentence or section. So just be cautious. If you like videos like this, I upload daily. I'm just trying to show you guys what's out there, show you the tools you can use to value your stocks, to go into trades, trying to help you guys out. Go through things I wish I knew when I started. So if you like the content, leave a like on the video, comment below, subscribe to my channel, hit that notification bell so you know when I'm coming out with new videos. I will see you guys tomorrow.